Welcome to another edition of AAIS Pulse. I'm Ed Kelly, and I am thrilled to be your host for the next 3 hours. We have an incredible lineup of informative segments featuring leaders in national and state insurance regulation, emerging technologies, and open source communities, and reinsurance. Before we get started, allow me to share some interesting information we gathered in surveys we conducted over the course of 2022. We asked insurance professionals from across the country to rate the issues that concern them the most. What emerged was a clear set of challenges facing us. Among them, the economy and inflation, attracting and retaining talent, litigation and tort reform, climate risk and natural catastrophes, and insurance regulation. Of course, what was not on our radar in 2022 was the potential for another banking crisis, and we hope this is a crisis averted. We'll touch on many of these topics and more throughout our program today. One major concern that seemed to grow in urgency over the course of the year was the availability and the cost of reinsurance and capital. Now, there are many reasons that reinsurance market was so tough this past renewal period. So we reached out to a couple of reinsurance experts who could shed some light on the market and provide us with an insider's perspective on the current state of play and the outlook for the market going forward. Here are the highlights of a recent discussion I had with Andy Marcell, CEO of Aon Reinsurance Solutions, and our good friend Frank Nutter, President of the Reinsurance Association of America. Frank and Andy, welcome to AAIS Pulse.
Great to be with you today, Ed.
Ed, nice to be with you.
Okay, so before we jump into the reinsurance market, I wonder if either of you think there could be any repercussions in the insurance or the reinsurance market as a result of the Silicon Valley bank collapse and the government providing access to the FDIC funds to preserve deposits. What do you think, Frank?
Well, Ed, I guess our observation would be that in looking at the industry's investments, it's not heavily exposed to banks at all, let alone the Silicon Valley Bank or the others that have been highlighted in the media, and therefore there does not appear to be an investment side of this at all. The industry does provide, of course, directors and officers coverage, which could be exposed if there are more issues with the banking sector. But it would appear to be somewhat not directly affecting the insurance sector.
Yeah, I would agree with that, Frank. With the exception that the sort of D&O commercial risk rates and financial institution rates have been falling, fairly precipitously for the last 6 months, and people talk about it, and this has given the reinsurers, the opportunity or impetus to sort of think more critically about the level of ceding commissions. So that's mostly the conversation that's taking place now. Are we, should we try and find more margin, the reinsurers say to the clients, given what's going on? And will there be, a economic slowdown that will further exacerbated by SVB, and will that further exacerbate any kind of sort of reserve development? I don't think that's likely, but that's the conversation that's happening for sure.
Yeah, and Ed, I would supplement what Andy said with this additional comment, and that is that one of the things of concern to the industry, and we'll probably touch on it later, are interest rates. And with the Federal Reserve continuing to raise interest rates, the question will be whether or not banks and other lenders will start pulling back and therefore achieve some of what the Fed hopes to achieve with regard to credit requirements, and therefore affect its future actions with respect to interest rates. Interest rates are just a big part of the economics in the insurance sector.
Right. Well, that is interesting. We'll have to keep an eye on that banking sector now for at least in the near future. Over the course of the last year, AAIS conducted surveys with insurance carriers across the U.S. to better understand their top concerns. Among them were the economy, talent, litigation, and tort reform, climate risk, and regulation. Frank, you speak with the reinsurance executives all the time. Would you say that those are the same concerns of reinsurers? And how would their list of top concerns differ, especially right now?
Yeah, Ed, I'd put a finer point on a couple of things that you've touched on in a broad way. One would be, you said climate. The industry looks at climate risks through the prism of extreme events. And I do hear a lot more discussion about secondary perils, so not the major hurricanes and earthquakes, but convective storms and hailstorms and other kinds of risks that are driving wildfire, other kinds of risks that are driving a lot of the loss experience in the industry. So I hear more about that, if you will. The other one that you didn't touch on necessarily is social inflation. It continues to be a concern in the industry that the basis that it's in its risk assessment, its risk pricing, since it is largely a retrospective actuarially driven model, may not fully take into consideration what we're seeing, if we weigh in terms of court cases, judgments, and other attitudes, if you will, about compensation related to all that. So I would add those to the list. There's nothing wrong with the list you have, but the refinement would be in those 2 points.
Great. Thank you. Andy, I guess it's suffice to say that January 1 renewal season was a tough one for the reinsurance market. I believe Aon called it a turning point, a new reality for buyers, a fundamental shift in pricing and risk appetite, especially for property cat risk. What were the major issues that resulted in such a tight market?
Oh, I mean, I have to go back to Frank's comment, climate change, the frequency of secondary perils, and they're sort of draining over the last 5 years of reinsurance results, had led to, and that's wildfire, severe convective storm, floods, and it's ubiquitous in the sense that it's in most regions of the world where this is evident. And as a consequence, reinsurers have failed to return their cost of capital to investors for some time. Eventually, people react to that and, or redirected their capital to their insurance operations or out of the industry altogether. And so as a consequence, the tightening in the marketplace was somewhat inevitable, and it was exacerbated by Ian. And, so in the end, when you load in property inflation, so U.S. clients need to buy more, limit to offset the inflationary values, and the international reinsurers in particular having less capital flexibility, which gets somewhat back to, not quite to SVB, but, interest rate rises are generally good for insurance companies, except when, you're having to market your bond portfolios and you have, losses in, unrealized losses, and you have less capital. And so that flexibility that, reinsurers would have to take on the additional demand and the need to drive more rate caused a squeeze on the clients. And the clients, we had predicted to a degree that there would be significant rate change, but the speed and that it happened, and it was fairly disorganized, right? And that was probably more of a concern for the clients, and how they navigated the 1st of January. And that was probably the most challenging time. In the end, we cleared it, but it was a very lumpy and not very structured process.
A lot of things coming together. Seems to be at one time, and we'll have to see how those items evolve over time. Frank, the RAAA joined together with other industry trade organizations on a paper addressing the growing property insurance crisis. Can you give us a summary of those results?
Ed, I'll start with the title of the report, which was "It's Not Just About the Weather," which would tell you something about the nature of the report. The industry does a good job in assessing catastrophe-related risk, property-related risk, and it does a good job in pricing that. What it has struggled with is the litigation system and the abuse in the system. Let me give you a couple of statistics. In Florida in 2021, there were $3 billion of litigation costs associated with claims resolution. So none of that focuses on the actual resolution of a claim that the policyholder has. And across the country, the amount of attorney advertising in 2021 was $1.4 billion of attorney advertising. it just suggests that the system is skewed somewhat, if you will, by the resolution, the cost of resolving claims, largely because of places like Florida that have had significant litigation industries, if you will, that feed on that. Another part of that would be fraud. The FBI issued a report saying that the amount of fraud in insurance in 2020, I believe, was $40 billion. And then the last thing I'd highlight that came out of that report was litigation finance, which is largely putting investors in the role of policyholders in the resolution of claims, pitting insurance companies not really against the underlying insured and the property, but against someone who's seeking a return on their investment. I saw a number that said that industry, the litigation finance industry, is probably $35 to $40 billion of investment opportunities. So, Ed, the nature of the report was to say the industry does a good job in property and the claims, the traditional way that it looks at insurance and claims, but it's faced with, in some places, a litigation system that skews the results of the industry for the industry as well as the policyholder.
Okay. Well, also, RAA was a driving force in passing the Community Disaster Resilience Zones Act of 2022. Tell us about that, and how will it help insureds and ultimately support the market?
Ed, the brief background is that when the Biden administration came in and began focusing on infrastructure investment, if you will, we had an internal conversation thinking, well, how can the industry be part of that? And concluded that one of the things that was of concern to the industry is retaining insurable communities where they were subject to some risk for natural disasters. And therefore, we came up with a proposal called the Community Disaster Resilience Zone Act, which would effectively identify communities that are at risk to natural perils, but also socially and economically vulnerable. And what this does is require FEMA to designate certain communities in the country as CEDARS is the acronym we use, as CEDARS community because they are vulnerable socially, economically, and to natural disasters. And then the grants that would be given to communities for pre-disaster mitigation would be prioritized in those communities. So the goal of the act is largely identification of communities. There's really a second part of our initiative, and that is to change tax laws that would incentivize insurance companies, banks, hedge funds, anybody that manages money to invest in municipal obligations for these communities when they issue bonds associated with pre-disaster and resilience-related bonds, if you will.
Well, a lot of good work there. Thank you. Andy, some tend to forget that the reinsurance market is a global market with capital coming in from all over the world. Is the global reinsurance market in any better shape than the U.S. market?
Well, I think what we're seeing now in Japan, although there's, in the eyes of the client, significant rate change and retention increases, mostly voluntary retention increases to mitigate the sort of dollars out of the door on the renewals. We're seeing a market that is, still much more ordered now than it was at the 1st of January. There is still pressure on available capacity, so there's no sort of sign of softening in any meaningful way. And I don't anticipate that for, for the next 12 to 24 months. I would say, though, that capital, it's a global market, and capital flowing into the market, which has roughly so far been about $3.5 billion, is relatively small, right? It will have no impact on available capacity. And at this time, there's a lot of conversations, but nothing meaningful is happening in terms of capital flowing into reinsurance for several reasons. One, the general economic condition and liquidity. Two, the idea of even if you can generate a 25 to 35% IRR in a cat fund or a retro fund, the idea that you could lose principal in an extreme event is very off-putting to investors. Third, there is a question from all the money that did flow over time into the ILS funds and constantly waiting for, we had a loss next year, there'll be a fundamental shift in it not occurring. that there's a somewhat of a lack of faith in the investors in those reinsurers' ability to sustain rate over a period of time. And, lastly, and probably more importantly, they do say that reinsurance, like property cat, can be modeled, which is good, but currently the models don't seem to be predictive of the outcome, which speaks to Frank's earlier comment on secondary perils and what's happening there relative to large single cat events. And I think as an industry, we're going to sort through that in the next 12 months and sort of align on, what adequate rate is, what our view of secondary perils are. And then I think some of our clients and clients around the world will start to pivot to figure out how to manage their capital relative to the higher risk that they're retaining. In time, we'll see that cost passed on to insureds. That is happening in high sort of peak zone markets in the US, and that will filter through in Europe and Asia and Japan over time.
Great, thank you. Frank, when the reinsurance capacity is hard to find and it ends up affecting policy holders often, and then we usually see some type of government action. You've testified before Congress about the National Flood Insurance Program, terror risk backstops, and other important issues affecting the reinsurance market. Is the government acting appropriately regarding this market?
Yeah, Ed, the industry faces a dilemma that when companies are either skittish about or pull back from consumer markets, government's in a position where they're not going to let that happen with some action taken, if you will. And in that regard, what we have looked at would be government programs that have been implemented to make certain that for the reinsurers, there's a risk transfer opportunity. So you mentioned the National Flood Insurance Program, which is a fully backed government program. It buys reinsurance from the private sector. The GSEs that are the secondary mortgage market, Fannie Mae and Freddie Mac, buy the credit risk transfer in the private reinsurance sector, even though we now know that they're fully backed by the federal government. And a credit to Aon in particular for its leadership there in creating that market opportunity. The Export-Import Bank of the United States also buys risk transfer. But even at the state level, where you've had consumer issues, such as in Florida or California, you have the California Earthquake Authority, which is filling the need that the industry, insurance companies are not interested in, and they buy a lot of reinsurance. Florida Citizens, Louisiana Citizens, also government actions to deal with consumer markets also lay off risk into the private reinsurance market. So, and I guess my answer to your question is, government's not going to let the consumer go without options, if you will, insurance. And from our perspective, particularly working with partners such as Aon, is to develop a way for the at least the reinsurance sector to participate in all that, as well as to look for opportunities to facilitate the creation or recreation of a private market. And the last one I'd mentioned that is under consideration now is cyber, a huge market risk, if you will. And we are engaged in discussions with the administration about whether or not there should be backstop there. The only thing I would you asked a question about is government acting responsibly. Certainly in a couple of places, notably California, where the insurance commissioner and your insurance department have been reticent to give the industry the kind of rate that reflects the exposure that it's writing, is not the kind of responsible action that government should take, but in fact find ways to serve the consumer, let the industry participate in all that, and not put the industry in a position where it just can't keep losing money year in and year out.
Yep. Thank you. Andy, they say it's all about capital optimization. And what does Aon suggest customers do to optimize capital efficiency?
Well, simply we tell them to work with us, but look, it's a very complicated question, right? Capital optimization, because, we talk about insurance companies as they're all like one thing, but they're like lots of different things. There's global firms, right? Like AIG and Chubb and Zurich and Allianz, and they have like really deep understanding of how to optimize their own capital, right? Our job in that sense is to mitigate volatility for them, and hope that, what we're doing is accretive to their book value so they get more predictable earnings. And in some cases, looking at their balance sheets to, assist with sort of legacy deals, right? Once you move away from those big globals, you have the big nationals that are also, sophisticated, but also have more capital flexibility. And then when you move into the regionals and the mutuals, right, that's a much bigger question for them because they're trying to serve a very bespoke section of the customer base. The ability to raise capital is less, right? And their desire to raise capital is different too. And as they've been forced in this marketplace to take more risk, optimizing that return for them is front and center in what they're thinking today. And so, if I was to, think about what I would do in their shoes, we tell them, you have to first understand, the cost of the business that you're doing and the impact to capital and make sure that fits with the regulatory framework that you're operating in. Secondly, are there some, tools that you can utilize to be more efficient in that, whether that's a retrospective reinsurance transaction or whether that's, creating some form of captive and reinsuring the captive and having that more effective in a rating model, whether it's Best or S&P. But then fundamentally, there's pricing dynamics. Can we assist and can people assist in pricing business more effectively? Looking at the cost of their business to drive out, costs and make sure that that's competitive. And in the end, the insurance consultancy business that Aon has, but all companies that utilize some form of insurance consulting, in the end, are we running the business that we want with the right features in terms of volatility and frequency, and where is that business and how do we best access it? All that, Ed, is wrapped up in this thing called technology and InsurTech, and there's multiple options of things that you can use to be more effective. In the end, all that soup of decision making comes back to, capital and a return on capital for everybody. And you have to be able to think across the whole dynamic of that sort of question.
Well, talking about capital, how is the alternative capital markets responding?
Well, they're showing a lot of interest. And there hasn't been, a tremendous amount of commitments, as I mentioned earlier, even in the cat bond space where money has flowed back into that space, but not at tremendous level. So the size of the deals is still, much smaller than they were, pre-Ian. If you could do a $750 million cat bond, now that's probably a $200 million cat bond. So again, I think there's conviction in our marketplace and how to give capital confidence that we have conviction in how to price the risk. And then secondly, there's the economic conditions which are locking up the movement of capital at this point. And so it will change. I think if there's no major loss in 2023 and reinsurers can return greater than their cost of capital and show that their, houses are quote unquote in order, then capital will begin to flow. And, that is a to be seen. That, look, the conversations there are happening every day in every country with every hedge fund, pension fund that imaginable, right? Because our job, as a reinsurance intermediary is to make markets for our clients, right? So that's what we, in the end, that's what we match, risk with capital, but we have to make more capital, right, for our clients. And that's where we're focused at this moment.
Great. Thank you. Frank, what are the major policy issues reinsurance executives are concerned about heading our way during 2023?
Yeah, I'll mention three, Ed. The first would be something that's been around now for several years, and that is a global minimum tax. The OECD, which the United States participates, has adopted a proposal focused primarily on global companies, wasn't targeting insurance companies, but really targeting the social media companies and Amazon and Google and companies like that do business in their countries but don't have a physical presence in their countries. They're seeking support for a global minimum tax of 15%. It seems unlikely the Congress will embrace that. But I do expect that to continue to be an issue, because if it's not a global minimum tax, then you're probably going to see these kinds of proposals on a country-by-country basis, which also makes it difficult for global companies to do business. So that would be the first one I would mention. The second one I would mention would really be one that kind of came out of left field, but it's an anti-ESG initiative. ESG, of course, has been embraced by a number of companies, not just reinsurance companies, and ESG being environmental, societal, and governance. So it's not just environmental. We are seeing in particularly energy states in the United States some significant legislative pushback about ESG initiatives, seeking largely to penalize companies that are using ESG factors in their underwriting. So 2023 will mark a significant year of trying to find some solution, if you will. The industry's proposal, including the REA's proposal, is that companies should not have restrictions on their underwriting prerogatives, whether it's pro-ESG or anti-ESG. That has not been widely embraced, if you will, in the states that we're dealing with the legislatures. But that will be, we'll see how that plays out. But that's a significant issue in 2023. And the last one is this focus we've had in our media about artificial intelligence. And I think the companies are still looking at this question of, well, what does that mean? Where is this in 3 to 5 years? How is it going to impact our business operations? And that's, of course, not clear yet and will evolve over time. But I would add that to my list of 2023 issues.
Great. Well, thank you. Yeah, I did not see the anti-ESG thing coming either. This is very interesting. Andy, as we're talking about the future, how would you categorize the outlook for the U.S. reinsurance market?
From whose perspective, Ed? From from our client's perspective, I think it's going to be more consistent, more stable than it was 1/1, but still it's going to be expensive relative to what they had experienced in the preceding few years. From a reinsurer's perspective, that's on a property cat side. For the reinsurer's perspective, they'll get the rate and the structures in the programs that they were seeking. The larger question is, on the casualty side, what the opportunity is there as the rate change in the original casualty business is modified. It's still going up in most lines of business by single digits, not in D&O. We'll see, per the first question of the day, whether that changes. And so it's a bit of a mix. It's a bit of a mixed bag for the reinsurers. They'll be keeping a close eye on reserve development, right? Number one, they'll be keeping a close eye on the demand, given the likely economic slowdown, for their products, and they'll be sort of hoping that they can sustain the same rate level on the property side, which is likely to continue unless capital flows, which at this time is locked up with that. So reinsurers, they're probably more positive if they were in the preceding few years, and the clients are frustrated. So we're working through that, but they're frustrated with the reinsurers for the lack of clarity at the 1st of January.
Well, let's just hope it's a less exciting year than it was last year. But thank you very much for those comments. But before we close out our session, Frank, I understand you are serving as the chair of St. Baldrick's, just a terrific organization. Remind our audience about their mission and how much they've achieved over the years.
Well, Ed, thanks for mentioning that. St. Baldrick's is a charity which focuses on finding cures for pediatric cancer. It was formed by 3 executives in the reinsurance sector and has been widely supported by insurers, both as to corporate contributions, but also the feature that St. Baldrick's uses, and that is head shaving, if you will, in exchange for pledges. St. Baldrick's has given 1,700 grants to researchers looking for cures for pediatric cancer, and over $326 million since 2005. So it's a remarkable charity. I'm honored to chair it, but I hope your colleagues and those who listen to this cast will take a look at St. Baldrick's as a charity of preference.
Great. Well, you two gentlemen have a good head of hair on you, so I'm looking forward to seeing it with a little.
And we could be next. Listen, I want to give a shout out to, and I know the opportunity now. You can't control me. The Aon Re Minneapolis. We raised hundreds of thousands of dollars, St. Baldrick's this time around, and to Richie Witt, the no longer the CEO of Marcell, who also grew his hair, and thank goodness he actually shaved it off. But he also raised hundreds of thousands of dollars, and so we're proud of our industry for stepping up, led by reinsurers and insurers. It's a tribute to the spirit of our business, and so thank you, Frank, for leading that for us.
Well, thank you, Andy, and thanks to Aon for its support both of individual shaves, and I know you contributed to Richie Witt's, but also the corporate contributions that you've made in so many ways. But it's a wonderful charity, and thank you for the opportunity to highlight it.
Well, thank you for your work. Gentlemen, thank you so much for sharing your insights with us. It is greatly appreciated.
All right. Thanks, Ed.
Nice to be with you.